I'm going to introduce our panel now and invite them to join me here. Julian Franks, Professor of Finance at the London Business School. If you wouldn't mind sitting 2 seats away from me there. Stephen Hester, Group Chief Executive of RBS Group. If you wouldn't mind sitting next to Julian there. Anshu Jain, who is Head of Global Capital Markets and Member of the Management Board at Deutsche Bank. John Kingman, Chief Executive of UK Financial Investments Limited, and will be explaining shortly exactly what that very important body is. And Xavier Rolet, who is the CEO, fairly recently taken over running the London Stock Exchange. Before we start talking about fixing the financial system, let's just very briefly work out how badly broken it is. And I'd like just a few short comments from each of you here on the panel, giving a score of somewhere between 0 and 10, where 0 is the whole thing, the whole financial system is in dust and ashes and nothing whatsoever can be rescued. And 10 is it's in such impeccable shape that this is how it should remain pretty well for all of history. I should be very surprised if any of you awards a 0 or a 10, but interested in the scores that you do award and why. Julian Franks.
Well, I suppose I'd give it a score of 6, you know, almost the wisdom of Solomon, somewhere in between. I think the problem is we don't really understand the sources of this crisis. I think if you ask people on the panel, and I hear we're not going to ask them what the sources of this crisis are, somebody will emphasize global imbalances, others will emphasize regulatory failures, and still others will want to blame the bankers. I always say that, quote Chu En-lai, who talked about the French Revolution or the 200th anniversary, where he said we just about understand the causes of the French Revolution, where we're still in the eye of the storm, and the idea that we understand the causes of this crisis, I think, is heavily overstated. We don't. We have some ideas, but is the emphasis right? We'll only know that in 5 or 10 years' time. So in scoring it, I kind of look at how we're dealing with it. And I kind of think that obviously we've got to improve regulation. I think that's crucial. The global imbalance is a great worry, but I have to say, I still worry whether government has got it right. I worry about the huge amount of guarantees that the government is giving the banking system. Martin Wolf has said for the UK, this is simply unsustainable. We have to reduce the size of the guarantees. And even though there's self-insurance and all that, we know the government and the state stands behind it. So the size of the guarantees, I think, is awesome, and we have to do something. And I don't mean about getting rid of some equities in the banks. I'm talking about the guarantees, the explicit guarantees, the implicit guarantees. We have to do something about that. I think that would involve pricing them properly. I also think that the issue of, let's call it simple banks versus complex banks. It's a horrible phrase. There's no such thing as a simple bank. This issue of return to Glass-Steagall, I think this is a very important issue, and this is something that we should be discussing the pros and cons of. So those are things.
All right, 6 out of 10, your score. Stephen Hester, what about you?
Well, I've learned to keep my head down, so I'm going to go with 6 out of 10 as well. Although possibly not for the same reasons. Look, I think it's clear that there are some very, very important lessons we must all learn, and there are some things to fix that will be big and will take years, and I can come on to that. But also, it's very important not to paint the picture blacker than it needs to be, and there are some reassuring things. The first is that from a position of potential near collapse, the world financial system is not in that position anymore. In fact, we have moved from that position to a nasty but recognizable recession. And we've all seen those before. And that was done courtesy of unprecedented and generally very successful government intervention. But in that sense, something has worked. The financial system has been rescued. The nexus obviously has been remade between government and financial system and is again functioning not in the way we want it to be, but still functioning. Similarly, a huge spectre that was, for me, out there was, would this shock cause the world to retreat into protectionism, both trade and financial, and put at risk the wealth and political stability that globalization has brought the world over the last 30 years. That dog has not barked as well, or at least it's yapped a little bit around the edges, but it hasn't barked. Thirdly, we have learned, which I think is very reassuring and important lesson, that the financial system does not stand apart from the economy. That one side of the coin might be reckless, over-leveraged banks. The other side of the coin was an over-leveraged economy, at least in the West, which the banks had to mirror because the financial system is no more or less than a mirror of the economies. And along with that lesson, I hope that bankers have learned a degree of humility, and certainly we should all have learned about the interconnectedness of financial institutions and the real world, or the real economy, or whatever phrase you want to use. Customers need banks, which is why governments have been forced to intervene as much as they have, and banks need customers, and with a dose of humility in that realization, I think those are preconditions for moving forward. So there are many things we have to fix. Some of them are regulatory. We have to grapple with the contradictions of knowledge through which mark-to-market effectively gives you with actually the ability to ride a recession, which has always, for all banks, required you to ignore some of the mark-to-market lesson for a while until you can afford to take them on board. Liquidity. All bank financial system regulation was focused on capital, and yet when people go bust, not just banks, all companies, people go bust because they run out of money, not because they run out of capital, although one follows the other. So liquidity is another huge issue. Large-scale financial arbitrage, we need to become much more suspicious. When markets appear in massive scale, driven by a financial arbitrage, we need to look that particular horse in the mouth a bit more carefully. And then, as you say, size and shape. It seems to me, and I'm sure we'll debate this more, so I won't expand, that the shape debate is a red herring. There is no correlation between success, failure, and shape, but size is something we have to think carefully about. The solutions are going to be global. They can't be one country. That will slow down the solution, but I think that doesn't let individual countries off the hook from taking a lead in putting forward solutions that can be discussed globally. And finally, I think one point that we should all, perhaps on a micro basis, learn is know your customer. Those banks that have known their customers got into the least trouble with their own customer. It was when you started wholesaling in other people's customers that there was a breakdown, if you like, between the knowledge of the system and the origination. So those would be some points.
One or two examples of the latter. It's interesting to hear you talk about humility, because I think we're talking generally about leadership, is the theme here. And one of the problems here about the financial system is the financial system is supposed to lead, in a sense. They're supposed to be the smart guys and gals at the top of the tree who know where we ought to be going. Unfortunately, in this case, there is a perception that the bankers led us over the cliff. Auntie Jane, if I can come on to you, how badly fixed do you think we are in the aftermath of all of this?
Charles, before I put a score down, let me contextualize the score. If this meeting was happening, say late October, first week of November, and 0 according to you was dust and ashes, I would have given it a 1. That was about as terrifying a state of affairs as we had. And to give you a more contemporary score, let me begin by breaking my dashboard into 2 distinct segments. On the positive side, I agree with Stephen. The single most important thing which has taken place since then is the bank's willingness to lend to each other. So systemic risk is off the table. It's largely off the table because of the very swift and coordinated regulatory and government responses we had, without which we could have actually lurched into territory which is hard to even put parameters on. There's, again, on your list of 12 things, let me add another one. It's called LIBOR OIS, something which none of you need to know about in normal times, but many of you, I suspect, have become experts on over the last 4 months. It's a spread at which banks lend to each other versus the risk-free rate. To give you a sense, it used to be between 5 and 10 basis points in the good times. It spiked to 350. It's like a patient running a temperature of around 107 degrees Fahrenheit for a long period of time. That's back down to 40. Very positive sign. Capital markets are functioning again. We've had $180 billion of issuance in the first 6 months. Actually, we're not quite through the first 6 months, and we've had $180 billion. To give you a sense of scale, that number was under 100 last year. So there are many positive signs that things are not as bad as they were certainly in the fourth quarter of 2008. On the worrying side, however, US housing, residential housing, the very famous Case-Shiller index, is down 32% peak to trough. It dropped 2% last month, and the Deutsche Bank forecast is that it's going to be down 42% peak to the bottom. That's another 14% from here. US bank health, for obvious reasons, is very closely allied to the Case-Shiller index. That's a very worrying sign still. Net lending to consumers, a topic which particularly in this country has understandable resonance, is down 90%. So UK net lending to end borrowers.
That's all, of all sorts, is it, including mortgage lending?
To private lending, including mortgages, yes. Down from 30 billion, I believe, to 3 billion. If I take a look at capital markets still, things like correlation, equity volatility, some very key but secondary symptoms of good health, also not in very good shape. If I add those two together, it's hard, but I would sort of come out at about 5.
About 5. 5 out of 10. John Kingman?
I'll happily settle for 5 or 6. Last autumn, as everyone said, the system was profoundly broken. It is very clear that a number of banks simply stopped lending altogether. Had that situation persisted, the consequences would have been truly dire. The world does feel a different place now. It feels particularly different in financial markets, where there are signs of the beginnings of a return in investor confidence. UK bank shares are up more than 90% from their extreme lows, and the prices of other bank capital instruments, which have been extraordinarily dislocated, are returning into saner territory. But of course, markets are anticipating what happens in the real world, and that confidence must inevitably be fragile until we start to see stronger signs of economic stability returning in the real economic data. Is the system broken as of now? Well, in one very important sense, no, it isn't. And that important sense is that the banks are lending again, and that was the crucial public policy purpose of the massive government interventions that we have seen. On the other hand, I don't see that one can say that the system is in any sense mended when the great bulk of banks' access to term funding is dependent on government guarantees. And in the UK, you see a number of very large banks which actually only exist, partly because the government is there on the shareholder register, but perhaps more importantly because the government is willing to provide extraordinary insurance against the value of very large amounts of their balance sheets. The other thing is, I think it is very important to be clear that there is no world here in which banks simply sort of shake themselves off, heave a sigh of relief, the world is back to 2006. It's not going to be like that, it cannot be like that. It's not going to be like that because banks are going to be very differently regulated, but I think it's also not going to be like that because banks themselves, having been through this extraordinary shock, are having to relearn the lessons of how they run themselves, and in particular the way in which they manage risk. My own little organisation has been set up to try and juggle this task of managing the government's involuntary equity investments in British banks. We have a very simple mission, which is to sell those assets over time and to manage them for value in the meantime. The task we've been given is to manage these assets commercially, but that is not code for, well, you know, we just leave the bankers to it, the world returns, as I say, to some sort of 2005, 2006 world. I think the banks that emerge from public majority ownership in the UK will look very different. In the case of RBS, Stevens Bank, there is a completely new strategy in place. The board looks fundamentally different, both the executive members of the board and the non-executive members of the board. If you take HBOS, again, that bank is being run radically differently as part of Lloyd's banking group, and that board is looking different. We as shareholder are also taking a close interest in some things that I think all shareholders ought to take an interest in. They include the way in which our banks manage risk. I think that is desperately important to us as shareholder. It also includes structures of remuneration, not because we think that we as shareholders should be dictating quanta, but because it is very, very clear that one of the things that went wrong in these organizations was the nature of the incentives that ran through them was fundamentally misaligned with shareholders' interests. And I would just say that that process of mending is one that is going to take years, not months, and I think, you know, before we're into the sort of 8s or 9s on your score will be several years.
Okay, Xavier, Rolet.
Well, I think the standard deviation of the answers we've had so far is pretty tight, so it's not a cop-out, but your question reminds me of a conversation I had with my accountant many years ago for my sins. I tried many years ago to start up a little firm, a biotech company, and after a year of hard work, sitting down with my accountant, looking at the balance sheet, so looks at it with a bit of a dubious look and says, well, on the left hand, there isn't anything right. And on the right hand, there isn't anything left. Or maybe it was the other way around. I don't remember. I think as you heard from Anshu last year, this is where we were. And I think by saying one, he was probably a bit more optimistic than some of the comments that you could pick up in the financial industry. And what is true today is that confidence has somewhat returned to these markets. So I'm personally comfortable rating it as a 5. What I would say, is that the recovery, the tremendous recovery in confidence we've seen in the last, say, 9 months, I don't think is going to be carried through the next 9 months. I think the pace of continued recovery is going to be spread over a much longer period. We're now looking at working through some issues that are really complex. It's quite clear, certainly in my view, that one of the things that's going to come out of this crisis with the relative humbling of the liberal market economy model, and let's say it the way it is, the relative humbling of the West versus emerging markets, actually creates a global world where everybody now is incentivized, everybody is a stakeholder. Emerging markets, including commodity producers, are now today incentivized to participate in our common world. And what I do believe is one of the outcomes of this crisis will be that a financial, perhaps economic, perhaps even political governance is going to slowly emerge. And whilst that may sound far-fetched, look, for example, on the regulatory side. Regulators today are doing more than comparing notes. They're looking at how systemic risk is shared, whether you look at the Americas, Europe, but also Asia. And there is some very, very deep thinking happening about and converging about how we should not only regulate, but also supervise our financial economy. One of the things that that has received a lot of attention, the sector obviously that has received the most attention in the last 12 months has been the banking sector. We're now looking at financial infrastructure. A lot of comments in the press in the last few months about clearinghouses, about OTC businesses. These are really hard issues to tackle, but they can only be tackled internationally. For a regulator, financial supervisory authority of a single country to come up with a solution will never work. So I think necessity is creating a new environment where regulators, governments, authorities are doing more than comparing notes. And whilst this will take a long time, these issues are really hard to tackle. We will come out, in our opinion, at the other end with a much more globalized world. The IMF is calling overall for 2009 for a negative GDP growth of 1.5%, which clearly means the world is in recession. Next year's forecast is a positive 1.7 to 1.9 GDP growth for the world as a whole, which still puts us in a recessionary environment. I mean, the IMF themselves estimate that it takes at least 3% of natural growth around the world to ensure that the world economy is growing, given the population trends, demographic, and so on, particularly in emerging markets. So economic growth today doesn't start looking really better until 2011. If one looks at US and Western mortgage markets, if one looks at unemployment, if one looks at protectionist threats that are rising, hopefully they'll be managed so far reasonably well, but they are nonetheless on the rise. It's obvious that for the financial economy to work itself through continued impairments, crisis in the mortgage market, particularly, and in the housing market in the US, and the expected increase in unemployment in 2000 and 2010, things will take some time. However, I think it's fair to say that the right questions are being asked, that regulatory authorities around the world are looking to resolve these issues and create new structures for the banking industry, for financial infrastructure, clearing houses, settlement. There are a lot of opportunities for regulators around the world to use this crisis so that we all, even if it takes a couple more years, so that we all come out with a significantly more stable financial infrastructure, so that these sort of leverage-induced crises are not repeated in the near future. Okay. So whilst I would agree to five, I think it will take some time.
I think we're going to look into the future in the course of the panel, but Shivani, what was your score there?
5.
5, okay. So essentially we're kind of somewhere between 5 and 6, really, which probably suggests that, well, there's plenty of scope for fixing. Let's say fixing now, because I think it might be too glib to say that we're thinking only in terms of regulation. There are other possibilities. There are possibilities which come from within the financial system itself. Jane, do you think that there is any chance that self-regulation might be given another try, or do you think that the experience of the past few years means that there simply is not the trust there on the part of government or public generally to trust the banks to sort out their own house?
The best way for me to answer that would be to give you a sense of what the banks have been doing over the past 6 months. Speaking for a bank which fortunately did not have to resort to government capital, has managed to weather the storm, although in a bruised manner, come through it in relatively good shape. I can definitely tell you that there hasn't been a complacent moment in the last 18 months. The crisis to me began really August 2007. We're almost about to celebrate its 2nd year anniversary. And over that period of time, a lot of the issues which are in the public domain, such as overall scope of leverage, transparency, compensation, risk models, there is a tremendous amount of work being done in order to address each of those issues. And I can give you a sense for a couple of them. Leverage ratios for the banking industry went from the low 20s up into the high 40s and have come back by almost 50 or 60%, completely voluntarily. One of the complaints is that banks aren't lending enough. Part of the reason for that is our risk appetite has been sharply blunted. A tremendous amount of work has been done on compensation and continues to be done. The IIF has just come out with a report, which I actually think pretty fairly summarizes the work which is being done by banks. Once again, voluntarily. Issues about alignment. John talked about that. I completely agree with it. We had a significant issue with alignment. That's well understood. It's being addressed. There's an issue with tenor of compensation. The component of stock awards, terms like clawbacks, where individuals are legally forced to give their compensation back if in years in the future their profit is deemed to be not as impressive as it was in the year of measurement. So there's a ton that's happening on the front of self-regulation and activities driven by the market. Is that going to be sufficient? I think we all have to understand that the significant pain the taxpayers had to take over the last 6 months to bail the financial system out is going to have its consequences. And as long as those consequences are manifested through a judicial electoral system, a regulatory system, which is driven by the best interests of banks as opposed to pure vengeance, I think that's no bad thing.
Stephen Hester, you've taken over at RBS Group. You've got clearly a new strategy, a new approach. And one of the things that I'm sure you would agree with is there has to be focus and there has to be a certain amount of urgency. You can't make a good decision and then rest on it. Do you feel, it's your impression looking around the industry, that enough is being focused on this, that enough is being done, or do you think that there's a danger that we're moving too fast, we're trying to think of too many things, we're trying to think too deeply, if you like, and actually there is a need for action now and for discussion now, rather than letting this process of fixing the system simply be drawn out?
I think there is a very difficult balance. On the one hand, we are all, I believe, policymakers and participants seized with the need for action and the depth and the extent of that action. And of course, the natural human instinct is therefore to race off and do all of these things. Equally, though, there is a risk that there are too many things to do, and if you do too many things at once, you'll botch them. There is a need, as a couple of people, including myself, said earlier, to come up with global solutions, which take more time to do, but better to get it right than to get it wrong and have to redo it. And there is also simply a need for survival first. There are some things which cannot be done immediately, which take time and will take a recovery of the world economy and a recovery of banks' balance sheets and financial health in order for a more conservative approach to be implemented. And so I think it is a question of trying to rev the engine as hard, the engine of change, as hard as it can go without blowing a gasket. But that is probably not quite as fast as in a perfect world you would pick.
Professor Franks, everyone seems to be talking about a global approach to this. The problem is global approaches to anything take years and years and years. I mean, it was stated from this platform earlier on that in its entire 10-year history, the World Trade Organization has not actually achieved a single successful trade round. And yet everyone says that more free trade is a good thing. Here we are, we're all saying more regulation, more intelligent regulation of banks is absolutely the way to go. But to what degree can it be coordinated, or is there a danger that if we wait too long for a globalized solution, we won't end up fixing the problem because nothing effective will be put in place?
Well, there is, first of all, we will need global or international regulation because we've got global banks. The problem is the costs of these failures have been borne nationally. And if you like, in part the Icelandic bank's failure, it was the UK taxpayer who in the last resort will bear the costs. So in that sense, if we have international banks, global banking, we've got to have global regulation. Having said that, I think the UK government faces a very serious problem. The reason why we give the banking sector 6 out of 10 is because the government has taken on a lot of the risks of banking to itself. That is, risk has been redistributed from the banks to the taxpayer. So I think that we're going to have to grasp some issues, some regulatory issues. Now here's one we can do. We can price guarantees properly. John Kingman talked about these enormous guarantees that we've given. I realize there's self-insurance in the banking and insurance sectors, but we all know that the ultimate insurer is the government, and if there's a failure, the losses are enormous. We have to price these guarantees properly, and they are not being priced properly, and that is storing up trouble for the future. The second thing is what has been said. Stephen alluded to it. He thought it wasn't the shape that was an issue, it's the size. We have to find a way of containing these guarantees. I think that means separating out some banking activities from the core activities where the guarantees lie. Whether this is an issue of shape or size is an interesting question, but we have to grapple with that problem. I do see that this is connected with global regulation. How can we take actions to reduce the size or change the shape of our banks when we're an international banking sector and we want to remain an international banking sector? So without some global regulation, particularly with the Americans and some of the Europeans, it's going to be very tough indeed. So can't do without it.
John Kingman, how comfortable are governments? I mean, you don't speak directly for the UK government, but you're dealing with them on a day-to-day basis, I presume, given that you hold the purse string, you're holding essentially the share certificates in people like RBS Group. There's always that debate, is that if you have too much regulation, no matter what industry you've got, you're going to strangle it. You're going to strangle innovation. Is government comfortable with this enormous task that it's facing, not just the UK government, other governments, that they're facing in trying to prevent another breakdown of the financial system?
I think comfortable would be an odd word to choose, but I think it's unavoidable. I mean, as Julian and others have said, the taxpayer in the UK and internationally has had to pick up the pieces. And it transpires that the scale of the financial risks that taxpayers are bearing is truly colossal. And I think that's one of a number of reasons why the system that comes out of this will have to look and feel very different from the one that went in. That said, the instinct which says these roles have to be redefined and let us, the government, reach to control everything is, I think, quite a high-risk one too. I mean, the British government had an interesting choice at a number of moments in the last 9 months, which was when institutions like RBS got into deep and profound trouble, was the right answer actually wholly to nationalise these entities, or was the right answer to get them the capital they need, the liquidity they need, and then to run them commercially? The British government went clearly for the second choice. I happen to think absolutely rightly. But as I said in my opening comments, banks that are run commercially does not mean banks that were run the way the banks were run in 2005-06.
Xavier Rolet, looking at this again, do you feel that there is confidence on the part of people in the financial system that they aren't going to be saddled with a degree of regulation which will be awkward and will stifle innovation, and also with a plethora of regulators who will trip over each other and ultimately prove either ineffective or simply disruptive?
I'd like to answer your question, but first a brief comment in terms of the bailout, which clearly is unprecedented. The numbers indicate so far the US has intervened to the tune of about $4,000 billion between money markets, direct equity stakes, TARP, and so on. In Europe, it's about 30% of the pan-European GDP. Whilst this is unprecedented on the global scale, it's actually happened before. Not that long ago, if you go back to 97, 98, in South Korea, the banking industry failed. The government invested 32% of the South Korean GDP in bailing out the banking sector. Bondholders, equity holders were wiped out, depositors were protected. The entire chunk of toxic assets, if we can describe them that way, were taken out of the bank's balance sheet and integrated in a huge sort of government-owned asset management company, which over time sold these assets. And in the end, well, that hasn't been necessarily advertised very much, but in the end took a 10% profit on the entire portfolio. And it's clear today when you look at financial economies and the banking industries around the world, Korea is probably faring a little bit better than some of its neighbors. So there is clearly an issue about the size of these bailouts. And to me, to answer your question, this drives into the way regulation evolves. No one country today can say, we got the right framework. This is what we were going to do here. And hopefully our neighbors will imitate what we've done. The problem is on a massive global scale. And it forces regulators to look at how they're regulating their banking industry. In some countries, we've seen, for example, in the United States, investment banks were not regulated by the central bank there, but originally by the securities regulator, and that has obviously conditioned the sequence of events. In Europe, you have a mixed structure, and it's clear today that there is substantial thinking in Europe, as well as in the US, as to what the optimum structure should be in the future. But that thinking is happening conjunctly, because it's clear when you look at some of the, we've talked to some of the investment banks or issues here in the UK. I think on the insurance side, for example, when AIG failed and was bailed out by the US government, analysts found out that actually the bulk of AIG's swap portfolio, particularly a lot of tax-driven structures, for example, were booked in the French entity. And so that drove into the Banque de France and eventually the ECB. These issues can only be tackled in that fashion. And in that respect, the fact that regulatory entities today are comparing notes and are seeking to, whilst this will take time, over time, align their response and align their thinking is a very, very, very positive trend indeed. Now, to continue to answer your question about regulation, of course, there's going to be there's a wall of regulation coming through, whether you look at the US, whether you look at Europe. Some of it will be positive. Some of it could probably be qualified as questionable in terms of innovation, in terms of where financial companies will be headquartered. There are clearly some elements in European, for example, regulatory initiatives as they target, in particular, private equity hedge funds and other such alternative management entities that will probably or could conceivably drive a fairly high number of such entities, not just out of London, out of Europe altogether. And that needs to be carefully thought out and thought through. But it's very important to look at regulatory construct, but also at supervision. The two are not necessarily the same. And there are still issues, I think, that remain to be determined. We've talked about the banks. Actually, if you look at exposure in the securities market, particularly in clearing and custody, the amounts of exposure and the size of balance sheets of securities clearers dwarfs the balance sheet of the banks. Right here in London, the most sizable clearing company in swaps alone has a little bit less than $200 trillion of swaps book. So it's very, very important as markets become more integrated that governments continue to look at what the optimum regulatory structure is, because that's the next stage. The lessons that have been learned, I think, in the investment banking and banking or universal banking, commercial banking, whichever way we describe them, I think have definitely been learned. There's not going to be a long and hard process where this thinking is applied to many other areas within the financial industry to ensure that we come out with a resilient and homogeneous global financial structure.
Let's come to a specific issue. Looking, Professor Julian Franks, at the derivatives market, which I think Xavier was referring to there, among other things. Do you feel that this is one of the big issues that needs to be tackled in terms of this whole question of fixing the financial system? Should we be worrying about the derivatives market, which has mushroomed in terms of its size, to the point where, by some measures, it's worth 10 times global GDP?
James Tobin, the Nobel laureate who died probably more than 10 years ago, he came out with this article, I think it was about 20 years ago, saying that derivatives should be taxed because he felt that the growth in derivatives would far outstrip the hedging of individual assets. And we all absolutely scoffed at it. He didn't stop him getting the Nobel Prize, by the way. I'm not in favour of taxing derivatives. I am in favour of efficient clearinghouses, but I also want to come back to this. I don't want guarantees, the deposit guaranteed money, which I think the object is to use them for corporate lending, private lending. What I don't want them to be doing is seeping in to, if you like, more investment banking activities. Now, while shaping the fight at the banks is difficult, so my worry is where that money is coming from, and whether, if you like, low-cost deposits is like feeding that market. But that market worries me. Clearinghouses, by all means, but I am worried about the size and the shape of banks and the way low-cost deposits, because of guarantees, is being used to finance these activities. That's a big worry.
Actually, just help us, because this is an area of business that you're particularly familiar with a quick 101. Some derivatives are traded, let's just kind of acquaint the audience with it. Some derivatives are traded on exchanges. Others are completely over the counter. One of the ideas is that if more of them were traded on exchanges, there would be greater transparency and one would see what risks were involved. Regulators will be able to say, okay, it would be rather like trading on an exchange like the London Stock Exchange or the NYSE. The problem is that derivatives are extremely complex and very, very diverse. Am I getting this right so far?
Absolutely.
Okay, because I'm not particularly familiar with this. I recognize that it's very important to understand it, though. In pushing for having more exchange-traded derivatives, are we barking up the wrong or the right tree?
Crucial question, Charles, and probably the question which has the most amount of ill-informed debate around it, understandably so. I think the growth in the derivative industry has outstripped the pace of comprehension of either the general public, or if I may say this, the media, which often commentates on our activities. Is there a source of concern? Yes, there is. But let's now go through, let's try and deconstruct the risks that derivatives represent. I think the first thing which happens is people get very confused between the clearing and counterparty risk which derivatives entail versus the market risk which is taken when you take a position via derivatives. So if there's one point I can leave the audience today, it would be to separate these two issues. So when a Bear Stearns was folded into JP Morgan, when a Lehman was allowed to go under, there was a lot of concern about the too interdependent to fail nature of derivatives. Because in simple terms, when a client executes an over-the-counter transaction with an investment bank, as opposed to doing it on an exchange, the major difference is there is an exchange of counterparty risk between the client and that dealer, or more importantly, between the dealers with each other. That has to be tackled. It is being tackled. There's a variety of solutions being put forward. Xavier alluded to them. The US Fed, the New York Fed actually has taken the lead on this. The banks themselves are participating. In simple terms, we will take derivatives and cut them in half. The entire clearance and settlement mechanism is going to be pushed towards clearinghouses. You will get much better transparency. Most important, the interdependence goes down dramatically.
But
however,
given the diversity, well, okay, but hang on, just a point as you go on. Given the diversity, in order to do that, there will have to be some, quote, standardization, won't there?
Absolutely.
Will we be throwing babies out with bathwater?
I'm so glad that you're asking that nuanced question, because at the risk of complimenting my moderator, that question has not been asked enough, and the answer is absolutely. There is a fine line between the homogeneous nature of pooling liquidity, which is what you get when you take the 10-year bond futures contract, one of the most efficient instruments in the world, or S&P futures. But let me give you a flip side example. Interest rates have dropped by between 700 to 800 basis points, 7 to 8% in some countries. If you're a pension fund or you're an insurance company, the value of your liabilities has appreciated to the tune of 30 or 40%. In simple terms, when you drop interest rates by 8%, you're discounting future liabilities by a dramatic amount. 5 years ago, and this is something which has not been commented on, banks worked very closely with insurance companies, particularly in this country, driven by regulation. The FSA was very involved. It was a very good thing. Insurance companies that hedged their asset liability mismatch using derivatives were given a capital structure advantage to do so. Customized derivatives played a huge role in helping. that ALM mismatch, that asset liability mismatch, would be far worse if we hadn't had these tools. So I think that line between pushing for greater standardization, greater transparency, better regulation through the use of exchanges, we applaud. To try and club everything under that dreaded B word, and some very famous people have joined that polemic debate almost, I think would be devastating for financial markets, indeed devastating for clients. And it's not just insurance companies. The price of commodities have varied hugely. So if you're an oil producer or someone that's whose input costs are linked to the price of oil, if you didn't have customized derivatives protecting and ironing that volatility out, you would actually be a much riskier company. And I can give you more examples than you have time for.
Okay.
The short answer is we absolutely are pushing towards standardization and a delinking between the clearing and the execution process. But to throw the baby out with the bathwater would be a big mistake. I'm very heartened to see that President Obama, for the first time, made a comment last week where he acknowledged the importance of customization and is not joining the hordes which are saying we should lump everything and push it on exchange.
Andrew, thank you very much. If there's anyone on the panel who wants to come in briefly on this point of derivatives, otherwise I'm conscious of the fact we've got half an hour still to go only, and I'd like to get the audience involved. So let's do that. Question from the audience. Lady there, and I'll just take one question if I could.
London Business School alumni. Perhaps a question for Stephen and Andrew about the fact that downturns often expose weak leaders and weak leadership. I'd be interested to know what, in your experience, you think are the attributes that distinguish leaders who become very successful through a downturn, as contrasted with leaders that succeed only when the markets are buoyant and in a high growth scenario.
That's not absolutely germane to what we're talking about now, but can we kind of twist it in with this whole question?
And the subtext I was going to ask was, as we move into an era of private-public partnership, what would be the attributes that would make those leaders succeed?
All right. In the context of the financial system, I'm going to spin this my way, if I may, because I think it's important we try and keep focused on this important subject. Stephen Hester, in the context of the financial system, which we're agreeing needs quite a bit of fixing, what are the attributes of successful leadership against that background, as opposed to the background of 2004, 2006, things like that?
Well, I think the first thing that I would say, perhaps in keeping with one of my earlier comments, is that I don't in any way set myself up as someone who can lecture on leadership. I think in a few years' time, I will be a case history in one direction or another, and we'll find out which direction. With due course, it does seem to me that leaders are almost never as good as they're made out to be when they're thought to be performing well, and equally almost never as bad as they're made out to be when things go wrong. And from that, I think I will just make just one other comment, and that is to say that it seems to me that one of the important attributes of leadership is to recognize its shortcomings and to build, if you like, a support and governance and leadership structure that does not have as its essential fulcrum one person. If I look at my own bank, one of my most important tasks is to turn the traditions of my bank upside down so that when I go to audiences in the bank, they don't bother to show up because my opinions will be less important, and that of the business leadership that runs the bank, who will represent a large collegiate base of mine, is more important. If you like, the syndication of leadership. And I think I would make that same point across the border between the banks and other places, that actually working with each other to have the checks and balances which don't just come from a governance structure, but come from empowering people to interact well with each other, is an essential mechanism for avoiding excess risk, whether that be allowing non-executive directors to interact well with the executive, and there to be checks and balances, whether that's regulators and government, vis-a-vis institutions that are regulated. I think all of these are relevant. So look, it's clear that many of the essences of leadership, making tough decisions, thinking strategically, being able to motivate, all of those are true in good and bad times. But I do think that in bad times it is worth remembering this point, if you like, about syndicating leadership and spending a great deal of time making sure that that works.
Stephen, thank you very much. Question there, in the light grey suit, just standing up. We'll get to one of the others.
Thank you. I'm Dominic S. I'm an alum of the business school as well. I've got a question to the three bankers, or in case of Mr. Rolet, an ex-banker. Mr. Edelman in the previous session referred to culture and social responsibility. And I think that, especially in the case of banks, where culture has been bred over generations, culture obviously has to change. My question to you is, how can you really achieve that, given that people who are in the banking system now haven't really changed that much? And isn't it just lip service that someone like Mr. Ackerman continues to state 25% return targets, and and basically reverts back to the old times without really changing inside the organization?
Xavier, would you like to take?
What I would say, though, going back to leadership, and I'll answer the point about CSR, to me, on the sort of back of 4 weeks of experience, I think it's got to be what Stephen said earlier, it's humility. That's what keeps your mind sharp when you have it. And when you lose it, and I come from a firm perhaps that was guilty of that, when you lose it, you lose your entire firm. The second point was about corporate and social responsibility and the general contribution, if I understand it right, general contribution that successful financial firms can make to society at large. The first contribution they can make, I believe, remains their contribution to the financial economy. This, a well-running, appropriately leveraged, sufficiently innovative financial economy, which is driven by all the financial players in an economy, is what is going to, by and large, create the most wealth, the bigger number of jobs, and the overall greater amount of economic growth. And it's just not here in the West. It's also emerging markets, where hundreds of millions of people are looking for economic growth today as their way out of poverty. That, I believe, is fundamentally the number one priority that the financial economy can pursue. That doesn't mean that CSR, and I think we've seen in the last few years many financial players raising substantial funds for charity or other causes, and even in hard times today where the needs are even higher. I spent a lot of time myself in the charity area. Today the needs are great, even greater than they were before. But I still see evidence that many players and participants in the financial industry are continuing to make substantial contribution to themes like children education, healthcare, training, development. So whilst there's clearly been some cases where, and they've been amply advertised in the press, where greed or dysfunctional governance have pushed us in an economic environment that none of us wished, there's still a lot of good things going on in that industry, and I think it's also fair to look at ways that these things are articulated in the press. There's no doubt that the industry can do more and can do better. And I think what we're living through is, at the moment, is focusing attention and energy, but I remain optimistic on the capacity of the financial industry at large and all its players to continue to make a significant contribution to society at large.
Gentleman over there.
There's been apparently quite some agreement about the fact that remuneration have to be changed, at least the way it's calculated. There's been, of course, this agreement a few days or weeks ago that Stephen Hester new package, 9.6 million. Why do you believe it is following what you just said about changing remuneration, and why is John Kingman agreeing with that?
Perhaps John Kingman can answer that.
I think
that I'm very comfortable with the package we've agreed for Stephen. The key point about it is that Stephen's rewards are very highly geared to the return the taxpayer will make on their investment. There are lots of stories in the newspapers saying Stephen will be paid X. Actually, they're all rubbish, because we don't know what X is until we know how the recovery of RBS goes and what the taxpayer's return will be. I think there is a deeper point here. We are choosing to seek to rebuild these banks by running them commercially. And the remit that I've been given by the British government is to approach the management of the shareholdings as a commercial investor would. Now, I think a rational commercial investor would want to see incentives that are well aligned to its interests, and I think that it's very clear that the investment community has fallen down on that job in recent years. But I also think that we have a very strong interest in RBS and other banks in which we have stakes being able to retain and recruit high-quality people. Now, clearly, we could employ or seek to employ a completely different philosophy. We could seek to pay much less than other banks will pay for talent. I think that would be a very risky approach for us to take, because I do not think I would be able to say, hand on heart, that we could sustainably have our banks run by the kind of talent that we need. So I think the key thing here is about the shape of the incentives. If Stephen does as well on his package as the newspapers seem to think he will, I'll be extremely happy, because the taxpayer will have made a huge profit on its investment.
Gentleman here.
Hi, my name is Michael Aslan. I'm a Sloan 94 alumnus and I'm an entrepreneur working in London. It's really a follow-on point to the point that was raised by the gentleman from the Tribune. Banking and finance is suffering from a crisis of confidence. We heard this morning the average CEO has 1/3 of the credibility of the average employee. Lucy Callaway, in her column this morning in FT, I think you saw, pointed out rather jokingly that Stephen's compensation is 600 times that of a teller in the bank. I want to say my comment is not directed at all at Stephen. In fact, I would compliment him for having the chutzpah, in fact, to attend today. But I think the elephant in the room that is not being mentioned here is really related to the message that the UK government is sending with regards to this package. It's not about, is the package fair, is the return on capital fair. The issues, the words that come to mind are probity, integrity, fairness, realignment of interests. And at the same time, the government then increases taxes to 50% and removes pension deductions for those in the £150,000 bracket and above. This, to my mind, sends the completely wrong message to the entrepreneurs in our society. And my question really is to John Kingman, who also I compliment on your work on the Miners and Sandler projects, which are excellent ways forward. My question is, what is the message that this package sends to the entrepreneur, and more what the government is saying when they agree to this scheme?
The first thing I would just underline is, this package is very highly geared to performance. So asserting that Stephen will be paid £9.6 million is simply not factually true. That is the first point. The second, deeper point is, quite clearly, we could say to ourselves, we should run these banks like government departments, and we should pay civil service salaries. I do not think that that would be a sensible gamble to take with the scale of the resources that the taxpayer has invested in this bank. We need serious people to run these banks. Those people are, by definition, going to be attractive to competitors. And actually, as Stephen will tell you, actually RBS and other UK banks are being poached. They're the receiving end of people trying to poach their people. And therefore, I do believe that it is in the taxpayer's interest that we pay sensible amounts that are correctly geared to the taxpayer's interest. It's also where, and it's, just a sort of acid test of, are we being a patsy shareholder here? One of the things we obviously did was talk to other shareholders in the space. And it is very important to remember that these are listed companies that have other shareholders as well. And quite a few of the other shareholders were very concerned about whether the approach that was going to be taken to Stephen's remuneration was actually going to be sufficiently competitive. That was the question they were asking us. So we had to balance these things. Now, I'm very comfortable having to justify that, and the context in which I do it is the remit that we've been given to rebuild this bank. We can make ourselves feel better on headlines by making different decisions, but I think we've made the right decisions.
Okay, let's just try and take this compensation issue more broadly, because it is an important one. It's said that an important issue for why so many people who receive bailout money, so many US banks that receive bailout money are paying it back, is they want to get government off their back. Julian, what do you think about this? Is compensation one of those big issues, or is it just something that the media and the public feel strongly about? Should there be regulation? Should salaries be capped off? Should it be strictly related to share price performance, or what?
Well, it certainly shouldn't be capped. Let me give a general principle. One of the things that concerns us about PLCs is that management, to use a phrase, does not have enough skin in the game, that they're not aligned with shareholders. And we praise entrepreneurs like yourself, we praise private equity because the managers are often the owners, they're often the shareholders. And the question is always, how can we get the PLC to mimic, if you like, the entrepreneur and or the private equity firm, etc. And I cannot believe the answer to that question is to cap their salaries. What we want to do is to make sure that salaries are designed very well. That is, success is highly rewarded, but failure is not rewarded. Now, I have no idea of the design of any particular, or this particular scheme, but I know in the case of one large public company, this is Martin Sorrell's company, that there's very large rewards for the board if they make it, and there are also penalties if they don't. So my own view is, I don't really agree with you. I don't think we should cap. I do not think it's a question of fairness. Our system is built on supply and demand. We don't worry, we don't complain if you like, a songwriter makes 150 million. That's kind of part of the market system. What we want to make sure is that success is really rewarded. I don't think we should begrudge that. On the other hand, where there is failure, it should not be rewarded. And I think that's good. There should be some symmetry there. Otherwise, I think we're going to have a very weak PLC sector, and we really are going to encourage companies to go private. I don't think that's very well.
Okay, let's take a question on another subject. Over there, white shirt, yeah.
Andrew Lambert's at Corporate Research Forum, and London's from here. I don't think your question about the challenge of international regulation is really answered, because if we think about the difficulties that chief executives of banks have had in understanding what the financial engineers are doing, if we're close to it, you know, the regulators have distinct struggles in terms of the competence of their staff to do that. And we've got a government who's actually still trying to decide which number of competing bodies should regulate in the UK. If you start putting that internationally, with all the international interests, competing interests there are, and the difficulty of running international bodies, I think we've still got a lot to answer to your basic question.
Okay, Andrew, I mean that is a point, isn't it? And actually, the banks could have a little nice strategy of running ragged, running all the regulators ragged as they try to compete with each other in order to get some kind of sensible system in place.
Which also give you an idea for the regulatory environment Deutsche Bank is in before I answer the more general question. We now have tripartite meetings several times a year where the US Fed, the FSA in this country and the BaFin all come together. Because Deutsche happens to be a global bank, and I'm sure it's no different for a JP Morgan, a Goldman Sachs, or a Credit Suisse. I think the issue that we've had so far was one of gaps and overlap. So on the one hand, you had entire swaths of the financial sector which might have had unintended gaps of adequate regulation. We've also had a ton of overlap, nowhere more so than this country. I think in many ways, much as banks and rating agencies need to go through a deep period of soul searching, we can see a lot of that debate on the front page of the Financial Times and so on in this country, indeed all over the world. Short answer simply is we need greater coordination and a deeper understanding of the advances in the financial system. I, for one, am very confident that regulators are moving very quickly to address all of those issues, and the level of coordination alone between the different regulators through this crisis has been very impressive. So the go-it-alone strategy, which frankly we've often seen heads of state take, is not being mirrored by the regulators. There is evidence of a lot of communication between them. I think the gap issue still remains, and it needs to be plugged, and it needs to be plugged from both sides. And frankly, harmonization of accounting standards is a very crucial part of it, which is not being talked about. I mean, the reality is you're looking at banks on this side of the Atlantic versus that side of the Atlantic being measured using completely different accounting systems. So when we talk about international regulation and the effectiveness, IFRS and GAAP present very different pictures of the same underlying financials. So the problems are many and very complex. The good news is this crisis has produced real dialogue and real effort in this direction.
Do you think it's any kind of run, and other members of the panel help me here, to have a kind of global financial regulator, actually have a body which is internationally accredited and recognized, perhaps a little bit like the early days of the European Union. Standardization of products so that everyone understood them. Harmonization of lawnmower noise was always a favorite story in the 1970s here in the newspaper. But actually, if you were making lawnmowers, it was very helpful to know that if you made a lawnmower for the Italian market, it would be recognized for the UK market. But equally, for financial services, is there any mileage, do you think, in the idea of setting up a body which did make sure that there were no gaps and overlaps, that the accounting systems were, if not identical, then at least transparent, mutually transparent, and made sure that regulation was effectively and uniformly enforced throughout the major financial markets of the world?
So a super global regulator, Jones, is that the question?
Well, we have something like that for trade. We have that for a whole number of areas. So intellectual property.
What we have is we have trade mechanisms that seek to combine national interests in a consultative manner, which of course, as was remarked earlier on, perhaps don't even work so well. But I think we would all, I believe we would all say that more coordination internationally of these matters is desirable, more cooperation. But finance also speaks to the national interest in every possible respect. If we just look at the current crisis, what goes on in our economies, the way our voters are impacted, the way our pension funds deal, the way big slices of our economy in the financial sector, all of these are things that governments never give up globally. And so I think what we have to do is we have to wrestle with a situation where governments and electorate want to keep these powers ultimately to themselves because of the consequences on their life, but where we all benefit from a higher level of international coordination. The EU is wrestling with exactly this point at the moment, and I think that the recent communique of EU governments suggested in the sense that this kind of attention, that the ultimate decision had to be kept nationally, but there was mileage in international cooperation to a higher level, and I think we'll see that being the direction that we follow.
Thank you. Question down here. We had a question a moment ago. No? Good. Yes, go on.
I'm Simon Webster. I'm an alumni of the school, and I'm not from a banking background, which I think I'm probably going to demonstrate now. The panel seems to be united about the importance of international regulation, but as an entrepreneur, it always worries me when people talk about international regulation, because I've never seen a good example of it. In fact, when I look at the fisheries, the environment, you name it, it seems to fail. And when I think of banking, I see it as two sort of elements. One is the utility, which is absolutely essential for us, and in a way quite a simple business that we know and understand well and manage the risks well. And when I talk about the other element, I think of it more as a casino with the derivatives, which frankly I don't understand, but maybe if it was the bankers' money they were putting in, in the old partnership type structure, then there might be more integrity and honesty behind some of those things. Is anyone considering actually going back to smaller organisations and taking things back rather than massive global scale, or am I missing the point of globalisation?
Yes, yep, go ahead.
The first thing which we have to look at is, if we look at the last 18 months and look at banks that have done well versus banks that have failed, there is no common pattern. So it's not as if narrow banks, Kingman was a very narrow bank, UBS is a very broad bank. So it's not narrow versus broad, it's not high leverage versus low leverage on its own. So business model, it's way too simplistic to say that investment banks have done badly. At the risk of praising a competitor, Goldman has performed superbly through this crisis. Phase 1, phase 2, phase 3. It's as close to a pure play investment bank as you're going to get. There's other institutions in the US which have had much more of a retail flavor, which have struggled mightily through this time. Indeed, it's their simple retail operations which are creating the bulk of the issues for them at this point. So it's way too simplistic to think that there are two banks out there, a simple clean bank which takes deposits, lends to corporates, which we checkmark, and then these horrible investment bankers that are running a casino. Simply not the case. And the facts over the last 18 months suggest that's not the case. The reality is much more complex than that.
Julian, you want to comment on this briefly?
I am less confident than you are. I certainly agree there's no great pattern here. Some simple banks like Northern Rock have gone broke. However, I think we should not, if you like, jump to the conclusion that shape and size is not an important issue here. There's no doubt in my mind, I taught in one bank last year, and I looked at its cost of capital. Its cost of capital was lower than that of a regulated water utility. Why could a bank a year ago have a cost of capital of about 4.5%, which is lower than a water utility? And the answer is because large parts of that bank were guaranteed. That is, the low cost of finance for banks was not because they were intrinsically very low risk. It's because, as I had said 2 or 3 times before, a large part of their activities were explicitly or implicitly guaranteed. We have to understand the interplay between those guarantees and the size of the bank and the leverage of banks and the incentives it creates. Is that connected with size and shape? With at least one of those, I'm sure it is. So I think we should not jump to the conclusion that the universal bank model is fine. Huge amounts of government taxpaying money is at risk here, and should we be discussing size and shape? The answer is unequivocally yes. It's complicated, so we shouldn't rush to conclusions, but the idea of saying, let's park that issue, I think is a dreadful mistake and will create the next crisis if we don't manage it.
Thank you very much indeed. So, another question perhaps over this side of the room.
It's a question for the panel. Sorry, my name is Jack Gallagher, I'm an alum of London Business School. It's a question for the panelists. It's an open question, but I'd like them to be very specific. Over the next 12 months, can you name one event or one change that you think will happen in the banking sector or in the financial markets, a significant change?
Okay. So, Rolet?
Very briefly, I want to add just one point to the question that was made earlier. I actually don't agree that international regulation doesn't work. If you look at human history and how long it takes to build, for example, a single nation state, and you look at the last 50 years of human history, when you look at space regulation, the seas, world trade, and in fact even the financial industry, these issues are extraordinarily complex. The pace of progress towards a global regulatory scheme, whether it's cooperative, whether it's coercive, regardless of the shape that it takes, is actually quite phenomenal. So I would have a different view in that respect for the one that was just articulated. Now to go back to the second question, and I will also be very brief, it's hard to say what will happen in the banking area in terms of regulation, shifts perhaps from securities regulator to central banks, harmonization of rules. I think one of the elements we haven't talked about so far, where London is particularly well placed, that I think will become increasingly obvious. The crisis we're living through at the moment is a debt-induced, leverage-induced crisis. In the UK, the fiscal code heavily penalizes equities, in favor of debt. That's just a reality accumulated over many, many years. I think the value of equity and equity investment out of this crisis will come out as a very, very strong message over the next 12 to 18 months. In London alone, we've raised £105 billion in the last 12 months of equities. There's a very, very powerful message here, and that I think each of the countries involved in this crisis will interpret in different ways. But one of the ways out of this debt-fueled crisis is to take another look at equities. Thank you.
Okay. John, let's use this as a concluding round, because I think it's very interesting. Just what do you think, one significant event that we're going to see over the next 12 months?
I don't think there's anything of which I'm 100% certain, but I'm very hopeful and indeed confident that one thing that will happen over the next 12 months is that confidence will build in the UK in what I believe, which is that we have every prospect of managing the gradual exit of the state from its investments in our banks and doing so at a very healthy profit.
Anshu?
I think this is a process which is underway already, as I've said before, so it's not a case of something that will happen in the next 12 months. It's more a case of acceleration and the bringing to conclusion of a powerful process which has been underway for the last 18 months, which is a sharp drop in the overall leverage and risk amongst the banks and the non-bank financial institutions in the system. We will finish the year with a much lower leverage ratio and a lower level of risk than we've started within the banking system.
And where will that LIBOR spread be at the end of the first half of 2010?
It was at 5 basis points for 3 years between 2004 and 2007. It was too low. I don't think we go back to 5 again. But it's at 40 today, and I'd like to see it around 15 to 20. I wouldn't be shocked, though, which opens up a new topic that we don't have time for on this panel, if it doesn't spike up much higher than that on the way from here to 5 and 10.
All right.
Let me leave you with that little teaser.
Stephen Hester.
I'm going to do that annoying thing and answer sideways, and that is to say, I think that we all, both as voters and as individuals, and in terms of our influence on the world economy, we face a choice at the moment, and it's not yet clear to me which way we will go. There are powerful forces of recidivism, and that's not the kind of recidivism that bankers want their bonuses back, although of course there are those forces, but it actually is all of us in some ways benefited from what brought the system down. We could take out, our house price equity went mushroomed, and we felt richer every year. We could take out loans to do almost anything and made equity extremely cheap. We had a borrowing binge, and at issue still is whether we will learn the lesson of what that led to. Because there are many siren voices, most of them with votes, and the electoral system is powerful at translating this, who would like an easy end to this, a quick end to the recession, the ability to go and get 90% mortgages, or even 100% mortgages again, the ability for companies to go out and liberally borrow regardless of their prospects. In other words, to forget this as a brief nightmare and move on. And most of us would like that, because we can go and take our holiday and buy our new car and not have to save more for our pensions. Most of us would like that. But if we do that, then we have an unstable world. And so in many respects, what I hope the answer over the next year is that the adjustment is more painful for us individually and as voters, but is more lasting and secure for the world as a result.
Julian Franks.
Well, when I hear about we must move to much lower leverage, I think of Augustine's quote, "God give me virtue, but not too quickly and not too much." I think it's like a very high savings ratio. If we have a very high savings ratio persistently, we're going to have a very deep recession. So it shouldn't come too quickly. I think that the UK, taking a UK perspective, must cooperate with the United States on bank regulation and with our European countries. We may not be able to get a worldview. Basel II has been a very serious failure. So the idea of a 10-year march with all countries signing up, I think, is really pie in the sky. But I do think that if we're to make serious changes in the shape or size of our banks, serious changes in regulation, we are going to have to consult and agree with the Americans and consult and agree with some of the Europeans. If we don't do that, I suspect nothing will change very much.
Well, let's leave it there. Thank you very much indeed. I think we better leave it quite apart. I think that's just about to be lunch, and we'll be deafened by the hubbub of the rumbling tummies of our audience if we don't let you go away. But thank you very much indeed for a very interesting discussion. Hugely complex subject, at times emotive, at times very complex, and thank you, all of you, for your contributions. Xavier, Rolet, John Kingman, Andrew Jane, Stephen Hester, Professor Julian Franks. Much appreciated. Enjoy lunch.